Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi, everyone, and welcome to episode 63 of the Capital Mind podcast. In today's episode, we're recording this at fairly short notice to dive into what happened with Silicon Valley Bank over the last week and what's happened after that. We're going to discuss, first, what happened and how this bank came under, what could have been done differently and at what stage, why there hasn't been a Fed bailout or has there, what happens next, and what lessons can we actually learn. Finally, since most of us will be sitting here in India listening to this, what of these learnings actually do apply to India? So do listen in to hear what Deepak has to say about Silicon Valley Bank and how it impacts all of us. Deepak, I guess we're all coming into this with different levels of awareness, and some of us have read more articles on this than others. Some of us have been doing Twitter spaces on this, and some of us not so much. So maybe let's start with a quick recap, or not so quick recap, on what happened. I mean, we see the news all over the place. It seems to be a bank failure. Silicon Valley Bank, or SVB, has actually failed, but there's no bailout apparently happening. And so this is the first one in 13 years? I thought we could start with this question. Can you talk us through what's happened and why has it happened?
This is a very important question, Shrey, because I think one of the things, let's lay it out. SVB is shut for all practical purposes. It was one of the largest banks in the US, top 20 bank in the US. In terms of size, it had more than $200 billion of assets. Over a course of just 3 days, gone from being worth $200 a share to zero. So what's really happened? And I think that's a very interesting lesson. I think, and I tweeted about this, there are 3 possible reasons. First, they had a very strange way of investing their customer deposits. Given the customer mix that they had, it's very strange. For a normal bank, it would be perfectly fine. In fact, very conservative for a normal bank. But given their customer profile, it seemed a little strange. Secondly, they decided to raise capital just about at a time when another bank was going bust. And then they told people not to panic. I think these are the 3 important things here. Each of them has contributed, possibly this thing. Of course, it's been exacerbated by the fact that their customers talked to each other on Twitter and told everybody to take their money out of the bank, which obviously creates a bank run, and then no bank can survive. But let me go back to what this bank was and what happened because of this. So this bank is an old conservative, typically conservative, and I say conservative because people think Silicon Valley is an aggressive place to be. But the bank itself was not very aggressive from any meaningful standard. What they would do is give financial services to startups. That's the and the venture capital community. They had a huge love or affinity for people in the valley, of course, but also for startups in general. The idea here was that they would not be serviced by any of the other larger banks. So we will give you services. What kind of services? Well, you know what? If you raise capital, put the money with us. We'll allow you to make your payroll payments and processing and all that stuff properly, which is fine, normal course of operations. We will also co-invest in your company. That means if you raise a $100 million fund, we may put in another 10 million as venture debt. This is essentially money that comes to you, which is a debt, so you can repay it. And also with some convertible warrants that gives me the ability to convert those warrants to equity, so I can get a better return than what I just make on the interest rate I charge you on the venture debt part of the ecosystem. Then I'll also give you some other services alongside. For founders who are in the startups may not find an easy way to find a mortgage because they want to buy a house, but the other banks are saying, listen, you're in a job in a company, it's not very stable, I don't really want to give you a loan. So they get a loan from these banks, from banks like Silicon Valley Bank, and it was one of the foremost areas. And of course, sometimes the startups themselves required more than just venture debt. They wanted a working capital loan to finance short-term operations. They would get that. But the way Silicon Valley Bank operated was most of its companies did not require any loans. So they would get a lot of money, they would raise money, and they would just use that money. for paying employees, for making payroll, for doing marketing, paying Google for ads and Facebook for advertisements and so on. So this is the, in general, the structure. You're very focused and concentrated, it turns out, on these companies. Now, typically way the company should have operated is that said, listen, my companies are people who keep using their money, and therefore they're going to keep taking out money from me and then paying their employees who may have accounts with other banks. So the money is actually leaving me all the time. But in 2020 and 2021, these guys went from, I think, $60 billion in deposits to, or $45-50 billion in deposits, to almost as much as $185 billion in deposits in 2021 end. From there, and when you get this massive influx of money, what did Silicon Valley Bank do with that money is they said, listen, I'm going to give you no interest for the most part. If I had to give you interest, what would I do? I would take this money and I would actually lend it out. But since most of you people don't seem to want any money, because you guys have raised capital, I'll go and park the money or a significant portion of it in government securities so that I'm safe. A good banking practice. Except what they said was, listen, you guys are all here, you have a lot of money. You're not all going to take it out at the same time, right? So let me just park some of the money in short-term securities, but most of the money in long-term securities. Now, what are the long-term securities I can choose? I use a mortgage-based security. This is just essentially an agency like Fannie Mae would pool mortgages and put it into this security. And this is kind of quasi-backed by the government in the sense that if there's a failure of a mortgage in any place, somehow you don't lose any money. As a mortgage investor, Fannie Mae and all take care of it. There's an implicit government guarantee on this, so it's safe. However, safe only from a credit risk perspective. The problem was, at the time, treasuries were yielding 0.25%, which is not great. And a short term, MBS was yielding 1.5%. So they said, oh, dude, what free money? I don't have to pay out any interest. I'll receive 1.5 on $100 billion portfolio. That's a few $1 billion in interest. Why don't I do that? Sounded like a good idea at the time. Except in March 2022, the Fed started raising rates because inflation was rising. Over time, Fed interest rates went all the way to 5%. 4.5% or something like that. And then you've ended up in a situation where when your interest rates are 4.5%, you have a bank which has $80 billion, or roughly, I think 57 plus 14, so roughly 60, 70, 75 odd $billion in residential and commercial mortgage-based securities held just in the hands about 80 billion, actually, a little bit more than 80 billion, in just mortgage-based securities, which are maturing typically 10 years from now. Here's another thing that happened with MBS. The Fed was the largest buyer of MBS during the COVID crisis and all that. So in fact, it's been one of those all QE1, QE2, QE3. It's been building an MBS portfolio. During the time when it started raising interest rates, it said, let me stop buying. It did not sell. It just stopped buying. Because it's the biggest player in this market, rates. So MBS trades, right? So if the Fed is offering 4.5% overnight, short-term US Treasury are offering nearly 5%, and MBS, which should offer, even though it's government-backed, should offer maybe 5.5 at the most. But what happened was, when the biggest buyer of this security went away, the rates went all the way to 7%. They went to 6.5 plus. So essentially, what you owned was a security where you put in $100, you get $1.50 every year. But if you want to sell that security that's yielding $1.50 every year, nobody's going to pay $100 for it at a time when interest rates are 5%. So technically, at the same 5%, if it was perpetual, it would be yielding only $30. So if you give me $30, I get 5% from somewhere else. I'll get $1.50 from you. So I'll pay $30 for this security. So I would have lost 70% of my money. But because of accounting knowledge, there's a slight difference because you'll get back your principal as well. The average price should be $72 to $75 on a security like this today. However, that means that if I had invested $100, I have a security worth $75. This is a $25 loss. So my $80 billion portfolio is down 25%. It should be down
to 60 or something. Yeah.
It should be down 64. So I've lost $16 billion in this portfolio. And if you ask me, the way banks operate, they're very leveraged things, right? They get deposits. And so how many deposits can you have and how many loans can you give? The answer is this. If you have $10 worth of your own money, you can do maybe about 100, maybe $150 worth of, you can borrow that much and lend out that much, effectively. So you have to have 10% capital, if they call it. Now, the capital at SVB was roughly $15 billion. Now you're telling me, Deepak, if they had $80 billion of securities and those have fallen to 64, they've lost 16. So if they've lost 16, they have to take their own, they take the hit. And that means they have no capital left. You're right, but unfortunately, banking rules allow them to defer this. So the way the system works, and we were talking about this earlier with respect to IT companies, if you have a contract that matures, say, a year from now, and that contract is tradable in the market, maybe it's a USD INR contract or something like that. But if I'm receiving dollars a year from now and I've promised to sell those dollars at 82, does it matter that price today is 85? If I were to try and sell that interest rate future in the market today, I would lose money. But if I waited till the end, then I don't lose any money because I was getting a dollar and I'm converting that dollar to a rupee at 82, and that's perfectly fine. The same thing with bonds. If you hold them all the way to maturity, because these are safe, guaranteed by the government kind of instruments, if you put $100, you're going to get back $100. Except if you try to sell it today, you'll get 75. This difference between what you can get today and what you can get at the end of this thing is just the mark-to-market loss, right? So I don't need to recognize it if I tell the Fed, listen, I'm keeping these securities all the way to maturity. Don't bother me with all this intermediate losses bullshit. So they put nearly $74 billion out of the 80 into these long-term hold-to-maturity contracts. So they declared that much was their hold-to-maturity. This is just the MBS part. I'm not talking about the other stuff. So they also had roughly, I think, 27 billion in something called available for sale. Available for sale is stuff that you have that you can sell if you want to because you're not holding it to maturity. Now, in India, if you hold something for sale and its price falls down, you're supposed to recognize the loss in your balance sheet and profit and loss statement in that quarter. In the US, they have a specific rule that's saying if you're a bank that has less than $700 billion in assets, you don't have to recognize the loss at all. So since SVB was only $200 billion, it chose not to recognize the loss even in an available for sale portfolio, which gives me a much. So essentially, I'm telling people I have $15 of equity. I have lost $15, but I can choose not to show them because of these two rules. Now, hold to maturity was as much as $95 billion in total, out of which $80 billion was just mortgage-based securities. And available for sale was $28 billion. This is end of 2022, the average balances of the last quarter. Now, consider this. This is your deposit book. This is how you've structured it. Except what was happening was the interest rates were going up. Their startups were not able to raise more money. Their startups were continuing to burn money, which means they were losing deposits every day because startups are burning. Now, as deposits kept falling, we saw that the deposits fell roughly, I think, 14%. 14% lower in 2022 compared to 2021. That means what was 185 billion was probably of the order of about 20 billion lower by the end. So it was 165 billion by the end of 2022. Now, when you lose $20 billion, you have to pay that out from somewhere, right? So you can't go and tell your people you have given loans, hey, give it back to me. Because they're like, dude, what the hell? But you have to sell off your securities that you own. So they've been selling these securities, and they've been seeing these demands for money from their startups continuing to increase. So somewhere in January and February, they must have decided, listen, we have too much money in this MBS business. Even the $27 billion we have in AFS, $6 billion out of that is in MBS, and the remaining, I think roughly 16 odd billion was in US Treasuries. Now, even in the US Treasuries, they had bought US government bonds, which were longer term in nature. with an increase in interest rates, we saw, and I think, Shrey, you know
My
this more than
TLT
me.
position is down 30%. So
There you
lucky
go.
me. Yeah.
So the 20-year government bond is around 30%. That means you had invested. Of course, if you hold it for 20 years, you'll still make back your money. But the government bonds were down 20-30%. When they sold this portfolio, they sold a $21 billion remaining AFS portfolio in the month of this thing. All were long yielding. These long yielding portfolios were sold at a loss of $2 billion. They took only a 10% loss. So, to their credit, they must have had some short term, some long term, but they sold all of it. And at the same time, when this $2 billion loss hit was taken, their 15 billion capital fell to 13 billion, obviously. Now they have less capital than they used to have, so they wanted to raise that 2 billion back again. They went to General Atlantic partners and a bunch of people. Essentially, they were now deciding that they have to raise this $2 billion. Normally, this would not be a big deal, except something strange was happening elsewhere in the market. Another company called Silvergate, which primarily takes deposits from but does not lend to crypto firms, was taking money from crypto firms and again investing their money into deposits, relatively small, $10-12 billion. It's not a big deal in the overall scheme of things. They were lending really long. And they had also bought these long-term deposits, which were again down 20-odd%. So now they had, if those crypto companies started to demand their money back because they needed it for their operations, they didn't have the money because if whatever they'd invested in is down 20%, so they couldn't pay back. And Silvergate was getting shut down. At the same time, this is last Thursday, the 8th of March, I think, they come out with an announcement that says, you know what, we're going to raise some capital. We've talked to General Atlantic. They've said we'll put $500 million. The rest of it, we're trying to arrange and all that stuff. It's only $2 billion. Don't worry about it. This is what it is. Now, at the when a bank like Silvergate is going down and you hear from another bank that they have had some losses and they're trying to raise some capital, you're like, dude, there's a problem over here. So somebody has to manage this communication very well, right? So now you're like worried and walking into a press conference by, the chief executive who literally says, guys, it's not a big deal. Don't keep calm. Don't panic. And if you tell a bunch of people not to panic, the only thing they'll do is panic. So the first thing they came out of that room saying, dude, just sell everything, just take your deposits out. Now, the minute people start hearing this news around, and this is where the complexity of like the new connected world comes in, a bunch of VC companies who have probably been benefited by SVB all along said, you know what, we got to protect our ass first. So every one of you who are investee companies, can you guys please consider taking your money out of SVB? Some of them were able to because they sent
Did it on Thursday.
The others were like, okay, should we really do this? And it takes a lot of time and all that. But by the time people start taking out their money, you can imagine what has happened.
This is a bank run.
There's a bank run. And when you have a bank run, and think of the scale of this, okay? So there are only, it turns out, 100,000 depositors who had less than $250K USD in their account. There are only $37,000 customers who have the rest. Now, if you have 100,000 customers with 250K odd, that they added up to just about $4 or $5 billion. The remaining 160 billion was with only 37,000 customers whose average balance was $4 million. So you're concentrated in very, very
rich people and
companies who have all this money and who are more likely companies than people, right? So and then they all want to take their money out, or they've all started talking to each other around in this Twitter, Facebook, or Instagram, whatever, and said, look, take our money out. And if you've got a panic like this, everybody's going to want to take their money out. It's a bank run. And then SVB is like, dude, what do? FDIC swoops in, says, guys, you have a bank run. We're going to take over the bank. We're going to stop everything. No more exits until we say so. They're coming in, and what is very interesting is that the timing of this announcement was probably even dictated by an SEC rule, because they could have raised at any time. Yeah. But when they started raising, once you've signed some agreements, apparently you get just 4 days to reveal it to the stock market. So on the fourth day they did, and that fourth day coincided with the time when Silvergate was kind of going down. So you had a timing problem, you had a public perception problem, and the words "don't panic," which is possibly,
Words I will never say again in my life.
I think Hitchhiker's Guide to the Galaxy
Yeah.
is probably the wrong term to use here. But what I don't understand sometimes is, okay, if you want to raise capital, why do you get a promise from General Atlantic rather than just taking the money? Take the money, issue them the shares, and say, I want another 1.5 billion. Then why do you... okay, we'll have a bunch of questions.
Okay, fine. I think you've given a good summary of what's happened. I do have a next question, which is fairly obvious. But do you think just taking the 500 would have made a difference?
Now it doesn't seem to be, because now when you
That
created
happened,
that panic, because you've had it. But I think it could have been managed from a PR perspective much better. And to a certain extent, I'd say even the VC community probably did themselves a disservice by not standing up for the bank then. And now they're all going around saying, no, you should rescue this bank. It's a great bank, such a fantastic institution. But why aren't you, why did you tell everybody to take their money off?
One prominent VC, in fact, wrote a letter to, I think, his investing company saying, take your money out. But yeah.
Yeah, which is
Fair. Take it. I think, as you said, this makes sense. This is a fairly nice description of what has happened. And I do think I get it. So you get money from your customers, many of whom are startups and so on. You invest it in a certain way based on, I guess, what was a world of low interest rates, which is both why your customers had money in the first place and what dictated the type of investments you made. Then as interest rates rise, your investments don't look very good. You start losing a bunch of money, and that sets off a vicious cycle, which in turn causes all this stuff to unravel. And there's some bad timing and some bad luck as well. So I think the next set of questions I'd like to get into is, okay, this sounds pretty bad. So at what point could you have done things differently? I mean, clearly come Friday morning, it was already too late. Maybe even come Thursday, it was too late. So at what point could you have done things differently? Who's the you in this case, I guess? And what could they have done differently?
This is a great question, because I think, the first question when you hear this description is, oh, come on, SVB does not understand the basics of banking. They should have duration matched. I'm like, no, that's not really it. Okay. If you told me in December 2021 that I have $160 billion, I would have also invested some part of it in long duration. Maybe not as much as they want to, but I mean, they remember, they have gone from 60 to 180, in 2 years. They're thinking, dude, there's more flowing in than that's going out. They're thinking that if there was more to go out, I had more coming in from other sources. At worst, I would just get as much coming in as was going out, and I would still be fine, so I can have some part of my portfolio in long-term security. I would say that in general, but I might have changed the mix a little bit differently. But I don't think this is a bad decision at that time. My problem is, what were you doing after March 2022? By your own admission, the bank itself was saying, listen, our companies, which are startups, are going to be able to raise less capital and they're going to burn their money. If they're going to continue to burn their money, I'm going to see outflows. I'm invested largely in long-term securities. So why should I not convert them now? And if they had done it, rates went from 0.25% to 0.5, then 0.75, then 1. So they didn't go up all of a sudden. They went up slowly. And during this time, mortgage rates also went up slowly. Fed stopped buying the MBS only in July. And they announced very well in advance that that's the date in which we're going to stop buying MBS. So whoever the financial officers were at the bank, they were aware that the MBS market is going to get less liquid, that the prices are going to go down because yields are going to go up, and the Fed is continuing to raise rates. Why would you not dynamically adjust down the mix over a period of time? And I'll tell you why. Because everybody's sitting in this boardroom saying, listen, if we take the loss, we have to recognize it in our books. Till we don't take the loss, it's unrealized, and then I don't have to show it in the books because there's strange Fed rules. Let me not take the loss. So I'm like, no, that's not how you should operate, right? It should be like, we're in the stock market. We know this stuff. So we get mark to market every day. We have to show our customers an NAV every day. So it doesn't matter if the stock is up or down. I can't tell my customers, listen, the stock is eventually going to go up. So no, you're worth much more than you are. But that's not the point. The point is you can get there, yes, but this is what you're worth today. And we get that feedback from the market every day. So what we do is We understand that sometimes certain things are going to be extremely volatile, and when they are extremely volatile, we sell some of them when we think the outlook is going to be much worse going forward. But I don't think I get a 20-year horizon to hold for my customers. So if I'm buying a 20-year security and my customers are startup companies who are going to take their money out at least, if not 3 months, at least 1 year, then I should be like, dude, I should be in 1 year securities, right? So I should duration match some part of this, but I can do it over time. I don't need to say, okay, the initial decision was bad. I don't have to keep staying with a bad decision. I could have gradually shifted out. This idea of gradually changing your portfolio along with the market, at the same time taking a loss, would have been a much easier way, because they would have been able to raise capital much earlier. They would have got out much earlier as well. And I think this is rule number one, is get your stuff done gradually. The other thing I will say is even the startups. Many of them have raised billions and billions of dollars. They have VCs who have billions and billions of dollars in the first place. They all have financial officers. I mean, many of them do. Or if not, the VC has financial knowledge. Could the VC not say that, listen, you have your money lying at zero interest with SVB. Can we please take the money out and put it into money market funds, which will yield you 1%, 2%? That 2% is more. At $160 billion, you're talking fairly large chunks of money that could have come just as interest, because SVB was offering you zero interest loans. Remember, SVB had $110 billion, 100 and something billion dollars in zero interest paying deposits. That means the startups that were given those $110 billion were earning 0% on their money. Only about $70 billion was in interest based deposit. And I would imagine that's a very low interest rate. Why were the startups not saying, listen, you know what, I need for my operational cash only 20 million. I have 100 million with you. Can we put 80 million into money market funds, which would have given me that 2% a year? 2% is still okay. And that 2% a year today will be 5% a year. So it's prudent to have done this in the first place. It's not like the VCs weren't aware of this, but they told their customers, told their startups to keep their money at 0% paying account. Sounds a little strange. So I think this gradual move, if the feedback had come from the startups themselves saying, listen, we need the money out, SVB would have acted much earlier and reduced their AFS holding of long-term securities much earlier than this. But they didn't get the feedback from the startups, because the startups also thought that this low interest rate regime was fine until it wasn't for them. Unfortunately for the startups, who perhaps shouldn't have been financially aware in the first place, because they're probably not doing anything on finance. But I mean, it's an ecosystem, right? It's like, if in India, we have a bunch of startups who get a lot of money. They have very prudent, we're talking to a bunch of them. They have their money in short-term funds and fixed deposits with multiple banks. Our own startup, which is Capital Mind, we can choose to be with one bank. We have 3 bank accounts, different money market funds to hold overnight money for our salaries, payments, and payrolls and all that. Different longer-term fixed deposits with different banks. Money in our own PMS, part of which is invested in shares and so on. Of course, I won't advise other startups to do shares and all that stuff, but we could diversify. We diversify just as a natural part of our business. And we're tiny. We're probably
1% of the size
yes.
of many people. But I take your point. But what this sort of reminded me of, and I know it's not a very correct comparison, but I think the theme is the same, which is in the UK during that Liz Truss government, when she did some stuff where the interest rates started going up, it triggered a huge bunch of sell-offs in UK gilts, I guess, or treasuries, whatever they're called over there, because of the same thing. People basically got money in a low interest rate environment, did some certain types of investments because they couldn't meet their payout needs or whatever it was, and then when interest rates changed, the world changed on them. So I guess what I'm trying to say, Deepak, is 13 years of low interest rates did have an impact in how we think about the world.
It's honestly quite sad, because the UK, it was the same exact thing. The high rate environment changed things. And when the high rate environment changed things, the problem was that these pension funds, what happens is in the UK, the pension funds have fixed liabilities. So that means you have to pay out a certain amount. So when you got money in and the interest rate was 0.5% and they had to pay out 2%, let's say they wanted to pay out 2% and on all that stuff, the only way to do things was leverage yourself 4x. And use swaps, which was a complicated thing. But the idea was, if I give you $500, you would give me, or if I give you $1,000, you would give me only 0.5% on it, even for the long term. Instead, I'll borrow money effectively, and I will give you $4,000. Give me, instead of 0.5%, give me 2% on 4,000. 2% on 4,000 is therefore, I don't know, $80. My $1,000 now earns $80. So, not $80, $8. I mean, it's probably a different thing. I don't have the exact numbers here. But essentially, I move away from a 0.5% earning exercise to a 2% earning exercise, simply because I lever myself up. When interest rates went up, my bond prices, which I had placed as collateral, lost value. The guys who I had borrowed from said, I love you, but you need to put more collateral. I didn't have any money in there. I was like, listen, the interest rates were so low, I had to lever myself to pay off my fixed income investments. But the point was not that. The point was, there also you could do it gradually. You could have watched the interest rate go up and reduced you would have, of course, fallen foul. But eventually, interest rates itself went to 2%. So you didn't have to have all that money in those leverage instruments, but you chose to wait, because otherwise you'd take a mark-to-market hit, and then things would hit the fan. I think this low interest rate environment has actually created a lack of fear of interest rates going up, that people thought the safest things in the world, like government bonds, could not lose value. And answer is, yes, they don't lose value if you hold them to maturity. But if you keep buying like 30-year things, everything can happen right now on the mark-to-market basis. More interestingly, I think, let me just add one part over here. The fear factor that should have existed in startups or in any ecosystem is far more prevalent in India. Because India always had 4, 5, 6% interest rates. Now it's become 7, 8% interest rates. So for us to move from 4, 5 to 7, 8 is not a big deal. For the US to move from 0 to 4.5, now that is insane. And here's the worst part. Europe has been in negative rates, and they've just come to marginally positive. If they go to 3% rates, I don't even know what else is going to happen. And we've taken a conservative bank down in the US. I don't know what happens to European banks, which are not conservative by any standard.
Well, thanks for ruining the rest of my Sunday. But I had, based on what you said, you just said it's a conservative bank. And I think I understand what you mean by that. Because, look, in the 2008-2009 crisis, these were reckless, irresponsible, just borderline evil banks. They did stuff that they knew was terrible. They just didn't apply thought, so on and so forth. And then they all screwed us over when the bailout time happened and so on. Here, there is no evil actor. There's a fairly responsible bank, got stuff wrong, unfortunately, made some bad calls, and then got unlucky on the timing. So what comes to mind to me is, back then in 2008 and 9, when there was actual, can I call it malice at play, you still came and bailed those people out and so on. Here, there doesn't seem to be any bailout here. What's going on? Why isn't this their job? Isn't the Fed supposed to come and bail people out?
This is a very good question, because I think this is the key to understanding why the crisis has evolved the way it is. First, let me put another thing. If there was a bank run in December 2021 also, when they had $180 billion and interest rates were very low, and they had their money in these long-term MBS and all that stuff, the bank was finished. That means a bank run will finish a bank anytime, simply because at some point you've lent money to somebody else. Maybe let's say it's even $40 billion. Put another way, HDFC Bank has 13 lakh crores in loans, let us say. But it has about 5 or 7 lakh crores in CASA, current account saving accounts, which are withdrawable at any time. Plus, all the fixed deposits, most of them are withdrawable at any time. That means you can go to the bank and break it. If 80% of, forget 80, even 20% of HDFC Bank's overall customers went and said, break my fixed deposits, give me the money right now, HDFC Bank is going to be seeing a bank run. It doesn't matter if it's the most stable, conservative, it's dead.
So I think your rule here is, if 20% of the people show up at the same time asking for money, no bank can survive. I don't care who you are.
And SVB was actually could pay 40% of a bank run. That means if 40% of its customers came and said, give me my money right now, they had it in government securities, they could sell them, of course at a loss, but they would still survive, as in they would still be able to make the payouts. This bank run was way more than 40%. And if most banks can't survive even at 20%, this bank could survive at 40%. And they got even more than 40%. I don't think this was like, this is basically, a person jumping off a plane with a helmet on and his parachute doesn't work. The helmet is not going to help that much, right? So it's like this buffers that we keep talking about, they're just designed wrong. I think, and one of the reasons I would say this is because there's a regulatory problem over here of saying the Fed says certain things are high quality securities. Of course, they're high quality, but their liquidity comes at a very big price. And that price differential of what people think the price is, which is hold to maturity prices, versus what it actually is, which is the actual market price, can be quite dramatically different. And therefore, the Fed has to recognize at some point that this is a problem. And by the way, India also needs to recognize it. India doesn't have the problem right now because I said rates moved only from 5% to 7%, and the banks are fine, even if they held all their money in government securities. They would have still lost like maybe 1 or 2%. So, but they're fine because it's only 1 or 2%. If you lose 20%, even the Indian banking system would be in trouble. So, coming to why there isn't a Fed bailout on this has a complex angle. First, I think the FDIC took over, and they did this with Washington Mutual a long time back in 2008 to 2009, and they folded that bank into another bank and made depositors whole. That was the largest US bankruptcy, bank failure in history. This is the second largest. Now, why is this not considered good enough for a bailout in a way? The answer is, who's affected? I told you, 37,000 people. That is not enough to make people hurt so much, right? It doesn't feel so bad. And think about what happened in Cyprus in 2013. Cyprus in 2013, there was a very interesting story. Separate banks were in trouble and they had a large amount of deposits. Those banks, the European Union wanted to rescue those banks, but they didn't want to rescue them without any kind of a moral hazard. They said, you did bad things, well, you should suffer because of it. And you know what? Your depositors should suffer as well. The Cyprus banks were told to take a haircut because they had 100,000 euros insured. Anything beyond that was not insured. So pay out the insurance, fine. Anything above that would take a hit. How much of a hit did they take? The answer is 48%. That means if you had $500,000, you got euros, you got 100,000, and then lost 48,000 of the remaining 400,000 euros. This was called a bail-in. It was a bad idea in general because it affects people in the banking system. But guess what? They said, you know what? A large portion of this money comes from these Russian people, Russians who are parking money in Cyprus. So within Cyprus itself, they were like, you know what? If they get screwed, it's fine. I don't want my friends to get screwed, but somebody I don't like, I don't think are great, if they lose money, it's fine. Think of what's happening in Silicon Valley today. If you look at America as a whole, they think this VC community and these startup founders are arrogant and
too rich,
and they don't share their wealth, and they've made people homeless in San Francisco by increasing the price of rent, whatever. So there is a resentment towards them. Plus, the Fed view is they're rich, they can take the hit. So maybe we should not bail this out. And how much will they lose? You know what? They'll get 50-60% of the money back anyway. Maybe they lose maybe 20-30% of the money. This is well affordable for many of these guys. So I don't care. And by doing this, am I creating a moral hazard on entire America by saying, oh, I'll bail out even rich people? The political problem. You have another problem of saying, listen, who's going to pay for this? Are the taxpayers going to pay for a bailout here? The answer is there's no appetite for that right now. I think there is no Fed bailout because of all of these reasons. Plus, I have a feeling the Fed themselves, when they look at the books, they're like, listen, we're going to be, if you take any other bank, the IndyMac went down in, 2008 again. The FDIC took over and did a similar thing. They liquidated the bank. When they liquidated the bank, they started selling its assets. It took about 4 or 5 years. They were only able to recover 50% of the assets after 4 or 5 years. Here, they're looking at a bank and saying, listen, 50% of the money is recoverable today. Shareholders have lost everything. shareholders are anyway going to zero. But after we recover that plus a few other assets, we're probably going to get 70-75% of the assets out anyway. So why are we bailing anybody out here? If you're going to get back most of your money, and even the remaining, maybe we can make some deals and get back most of the money in maybe 1 or 2 years. If that is the thought process, then the Fed is absolutely right. What it would be wrong in is if all over America, people started saying, listen, they could do this to our bank. Let's get the hell out. Given the superstructure of the resentment against VCs and all of that stuff, I don't think that seems to be a problem right now. But if there are no reassurance statements from the Fed, a lot of small regional banks who get deposits from their local, customers and all that might find it difficult to continue keeping their deposits in their current banks. But I feel even that, because most people are intelligent, they won't keep low-cost deposits with banks anymore. They're going to move their money into money market accounts. And banks themselves are borrowing more and more from the bond market, where they don't, if you buy a bond, the company you buy a bond from you can't go to them and say, I want you to take my bond back early. That's just not happening. So if banks themselves finance themselves more from a bond market, then they can delay this, eventual thing as much as possible. So I think the Fed delayed the bailout primarily because there's been political pressure not to
and
do
some, I guess, more of some social pressure as well, according to you. I guess I'll just add one comment, which is I actually know a couple of people who've been impacted, and maybe you're right, but it does feel tragic because, as always, 99.99% of the victims are generally just honest, hardworking people who are now victims of someone else's mistakes. So
it's collateral damage. And I'll give you an example. It happens to all businesses where some collateral damage happens for strange reasons. And the strangest reasons could be, for instance, we're running a business in India. Well, let's say we have customers from, China. And there is suddenly a war between India and China. You lose your customers. That's the way the business is. Your collateral damage. I didn't do anything wrong. My Chinese person didn't do anything wrong. I love them, but
Got it.
So you have your collateral damage in a lot of ways. In this case, it just seems extreme that I can't even touch my money.
Yeah.
But yeah, I feel really bad for the founders who've worked hard, who probably don't have the financial knowledge of all of this stuff happening in the background, and yet they're scrambling to struggle to do things.
On that, also your point of, if there is now a fear among many people that my other small bank will, you may have a massive run on banks and everyone moves to, I guess, JP Morgan or someone. But anyway, we'll see how it pans out. I guess by the time this podcast comes out, this will either have happened or have been disproven, or maybe someone who has actually comes for a bailout. You came up with a number of 70-75%. So can you tell me what happens next now?
Oh, this is interesting, actually. So with the way FDIC operates, and the reason I put 70-75% is because I think it's going to operate in one way.
Okay.
But the first thing FDIC does is takes over a bank and says, listen, guys, anybody who's insured, I'm going to pay you out first. That means if you have less than 250K in your account, you'll get back that 250K. You should wire it out or do something with it. At the same time, in parallel, they're going to be working to find a buyer. Then they go to a buyer and say, listen, so let's say they went to a big bank, JP Morgan, or, the JP Morgan said, fine, I'll buy the whole bank. But you know what? I will not pay 20% of the depositors. FDIC is going to be like, excuse me, but you're sitting in this seat for only one reason. You're going to buy 100% of the assets and 100% of the liabilities, and there's no other bullshit. So the JP Morgan, but I don't want to give founder loans on mortgages and all. I don't give a shit. You're buying the good stuff and the bad stuff together, or you're not buying anything at all. So this is the typical way discussions happen. They're not going to sell it to a bank that says, I will not honor a portion of the depositors. It's just not going to happen. So they're going to be like, okay, listen, you either all or nothing. These discussions by now should have resulted in a buyer, in my view. Of course, we still have the Sunday. We're recording this on Sunday, March 12th. So we still, by the
time this comes out, there may be a buyer.
So let's say they're able to find a buyer, then everything goes like Washington Mutual, where all depositors are made whole, shareholders lose all their money, everybody else is fine. What happens if they don't? Now, let's say they don't. And this is the thing I think is happening. Now, basically, the FDIC is looking at this and saying, listen, guys, we have a bank. that has $80 billion in assets, which are worth $65 billion. Let me say net of everything. We're able to recover. There's some bunch of government bonds and this and that and all that. We're still able to recover $80 billion. There are $160 billion of deposits. So we should be able to pay back half the depositors immediately. I'll pay the insured people as well. Of course, the FDIC pays that from its own pocket.
On Monday.
On Monday, because it gets deposit insurance from all banks. It charges every bank a certain amount of money. So it has that 250K that FDIC will pay. This is not going to come out of SVB's books just now. But eventually, SVB's books will see some recovery, that 50% of assets will come out. So they've said next week, whoever is uninsured will get a one-time dividend, which could be 50% of whatever else is owed to them. And on top of that, the remaining 50%, they will receive, the remaining whatever money, 50% is my number, they will receive a receivership certificate. So that means, I owe you. So if you have $500,000 at the bank, you get 250K, plus of the remaining 250K, you may get a 125K one-time dividend. And the remaining 125 is said, okay, you have a receivership certificate as and when we sell the other assets of, so remember, they have $110 billion, they had $110 billion in marketable securities, and the remaining $70 billion as loans. So I'm saying that $110 billion might have fallen to 80. So let's give back 80. And then remaining $70 billion will go, there's a home loan by a founder. I'll say, listen, does anybody else want this home loan? This founder is a good paying guy. Well, they say, okay, you know what, I'll buy it, for 80 cents on the dollar or for 90 cents on the dollar. So given that, there will be a 10-20% hit on everything that they take, because they're going to sell this in. It's not going to be a fire sale, but it's going to be slowly sold. So I would imagine of the remaining 50%, you're going to see, I'm not saying, let's assume 20% of the total asset value is lost because of whatever reason. So if there's $100,000 remaining, you're going to lose $20,000 just to market dynamics. You'll get back 80. So I would say expect 20 to 25% of losses on your deposits, which means that is how liquidation will work. But it should be reasonably fast, because as I said, 50% should be out fairly fast, and the remaining, it shouldn't take 3-4 years. It should be done by the end of this year, hopefully. And much of that money might come out earlier. So I don't think people who have large deposits are losing their money. They're losing some portion for sure. At least I would say eventually assume 25%. But in India, what happened in a lot of banks was that deposit insurance works up till 5 lakh rupees.
Which is minuscule compared to 250K.
Which is minuscule compared to 250K. So it's in a lot of cooperative banks, for instance, which keep going down, these deposit insurances are supposed to be paying out. But by the way, they don't operate anywhere close to the efficiency of FDIC. FDIC is super efficient. They know how to do things. They've done this before. RBI, in comparison, has a few banks. Then it takes a lot of time to pay out a lot of these claims. But what is interesting is in Yes Bank's case, when they swooped in on Yes Bank, they got SBI to buy Yes Bank. They could do the same thing with SVB. But apparently, they are not very keen on some of the largest banks buying SVB, because they're saying if the large banks buy SVB, they'll just become larger. And I already have a system with concentration risk. Can I please not do that? So they'll have to find a bank which is not too large, but still has the balance sheet capability of buying an SVB and making depositors whole by selling the assets, even though there is a $16-20 billion hole in this. Who's going to pay for that $16-20 billion? The answer should be the current equity holders that are gone in any case, and perhaps anything else that they lose while selling or while managing those loans. Because if you remember, they make working capital loans to startup companies who probably have their money in SVB. So now you're telling this company that has this short-term working capital loan, listen, I can't give you access to your deposits, but somehow you pay me back. The guy's going to be like, listen, I don't have the money to pay you back because I need the money to make the money to pay you back in the first place. So if you don't give me money, I'm not paying you back. So you suddenly get NPAs from these companies. So the $70 billion in loans, I'm sure going to see some NPAs, because some part of it is going to... So the guy who's going to buy these loans or buy the bank itself is going to be like, I'm not paying for those and in full. Somehow find a way to make... If you want me to pay depositors in full, these loans are a problem. So how do I get access? How much am I actually paying? So the answer would be, whatever it costs you to have paid to get access to these customers in the first place is probably what you'll pay. And given the fact that it's a very relatively small bank, 150,000 customers, even if I paid $1,000 per customer, I'm paying less than $1 billion. To get access to these customers. If they're worth less than $1 billion to me, then I don't want to take too much of a hit on the portfolio, right? So I think here is where it becomes very interesting, and I think we should assume in India, yes, SBI got 48% of Yes Bank, and a bunch of other banks hold it. In fact, tomorrow, Yes Bank's that is 13th of March 2023, all shares that were bought in at that time were locked in for 3 years. They actually open up and unlock tomorrow. So we'll have to see what happens there. Yeah. That's a different thing, but I don't think that bank's going under. It's just that people get to sell their shares when they want. In SVB's case, the name SVB is finished, regardless of what happens. Tomorrow, either a new bank takes over and you'll be dealing with a new bank. You no longer have deposits with this. If JP Morgan takes over, you'll be dealing with JP Morgan. Or SVB is piecemeal liquidated, in which case, again, there's no SVB. So it's the end of that name. But, I don't think anybody should panic right now thinking they've lost all their money, because a significant amount of the money will come back.
On that, I do think that there may be some element of contagion risk here, because it's quite worrying look, it's one thing to lose money in the market. That's something we're all kind of mentally prepared for. But even that, as you know, is painful, and everyone panics and gets upset. To actually lose money from a bank account is a very chilling experience. So let's see how it pans out. Looking further forward, I think as people, we all have the tendency that we overlearn from the current crisis and keep building out infrastructure for the current crisis. And maybe you have to, because if the same crisis hits you twice and you weren't prepared, then the world will not be very kind to you and they'll mock you relentlessly. But the fact is that generally it's not the same thing that hits you again, right? It's something else. But so what are, you think, the reasonable lessons you can actually draw from this? Realizing that this may not be the next crisis that hits you, but you obviously want to be better prepared going forward.
I think you had two excellent examples, and I think you talked about 9/11.
Yeah. So I think when I was reading Alan Greenspan's book, I think the example that he gave was that after the first attack, everyone was like, "There's going to be another," and that they lived in fear on that for another year. But as you know, it's been 20 plus years and they haven't had one. So that wasn't what they had to prepare for per se. But of course, you have to. The second example I can't repeat in public, so let's keep it private.
Let's keep it private. So this is actually interesting, because you can actually end up over preparing yourself for a crisis when there may not be any need to. This is so true, because I think in India at least, we are fond of extreme conservatives. Kuch mat karo. Because agar kuch nahi karoge, then kuch mat karo means just don't do anything. But if you don't do anything, then how will you ever do anything is the question. This is of course coming from Finding Nemo and a Dory dialogue. But the idea is, if you have to give yourself a little room for failure internally, and this is a failure. So at some point, this should have been the impact of having those extremely low interest rate environments. And I think the wrong lesson to learn from this is to never bank with any bank that banks only for startups. I think that's a silly way to put it. But I would say, yes, you should be reactive. You should be reactive to the world. So when interest rates are going down or going down, you're going to behave very differently from when interest rates are going up. The world is changing. In the stock market, we are reactive in the sense of saying, listen, this something has changed. This something will no longer, the rules of the past will no longer apply to the future. I need to change my portfolio. I switch out of some stocks, which I love, but I will switch them out, and I will, buy something else which looks better in the next few years. So in the parlance of, a stock market player, you don't hold something forever. Just this buy and hold forever just does not apply. When the whole world shifts under you, you just say goodbye to the guys that have helped you along till now and move on to something else. I think the answer to that happens whether it was Silicon Valley Bank that said, I had to take those losses when it was March 2022. Okay, fine. June 2022. Some losses should have been taken and adjusted. You have to be reactive. You have to change your portfolio according to the times, especially if you're a leveraged institution or you deal with leveraged institutions. So if you as a startup today are taking out from this lesson, don't bank with X, it's not that. Actually, you should bank with multiple of them, and perhaps spread your portfolio around a little more. And that's the diversification angle as well. So people keep, there's been a saying attributed to perhaps Warren Buffett or Charlie Munger saying, put all your eggs into one basket and watch that basket. I'm like, what good would watching that basket do? You didn't have any control over that basket. You saw it fall. SVB put all their eggs into an MBS basket. I'm sure they watched the basket, but they didn't do any damn thing about it when they watched that basket fall. That doesn't make any difference to you. So you should be diversified from the angle of saying, oh, I am going to be diversified across my bank accounts. Individually as well. I have 8 bank accounts. I don't recommend this to anybody, but you should have 2 at least, right? So you should have 2 because, and I was having a webinar about advising senior people, and I said, please have 2 accounts. There's a reason for that. If something happens to one bank, you should be able to move your money to something else, which is another bank, fairly fast, and should have some money in both banks so that you are able to, kind of switch it around. I think people having diversification is an important thing. Having that diversification, over diversification is possibly bad, but having some level of redundancy is fine. I have multiple bank accounts because I want to test their user interfaces, but it gives me the alternative that tomorrow if one of these banks fails, and by the way, some of these banks, big names, I won't name them, but their net banking used to fail every Friday and Saturday. And I'd be like, dude.
Or the first of the month, if you remember.
First of the month. So I would be like, dude, you're not getting any more of my money. Only when they fixed their net banking practices, I slowly started bringing the money back here. And, Indian banking system allows you to take your money in 1 second. The US banking system is archaic in the sense that, A, they have these horrible rules that allow people to have losses which they don't recognize. But, the the past rules don't apply anymore. I'll move into another thing. The diversification angle is good at multiple levels. And if you're a startup, and maybe I'll come to these things later, there are some to-dos that have to be done. But the rule of thumb would be, don't be loyal in business. Loyalty is for humans on a personal level. You want to be loyal to your wife, your children. All of this stuff is useful. It's emotionally very, very satisfying. A business does not have too much place for loyalty. We've seen this, layoffs. One of the biggest concerns that people said, our company laid us off. And in India, we seem to take that personally as well. How can they lay off this guy? He worked for them 20 years. Businesses are not designed to be loyal, and business is not designed to be loyal. When things start changing, you move out. You should expect that no loyalty will be given to you. That means your long-standing customers can cut their contracts with you at any time. Your banks can cut their contracts with you at any time, which means you have the ability to cut your contracts with your banks at any time. This bank run that has been caused is because these people who have been benefited by SVB all these years, all those parties, the loans at the right time, the handling of your accounts when nobody else would, was done by SVB. But it got no loyalty from some of the people that it had helped the most. In a leveraged world, not having a loyalty means having the conservative buffers that, things will change. And lastly, don't overreact to even the current situation in the sense of, we know what the FDIC does. And if you look at this bank, this is not a bank that has gone out because of lending to bad credit. It is just lending to credit which just matured at a different time. It is not the same as a subprime bank where you can't even recover your money. You're going to recover it over time. The recovery is going to be fairly fast, I think. And in all probability, either you get a bank rescue or you get 70% or 50 to 70% of your assets out by the end of this month or even this quarter, maybe the coming quarter. So given that, I think you should stay calm and arrange for alternative sources of finance while this thing is getting resolved. And of course, going forward, don't say, oh, I had an account with SVB, I'm going to open my account in one other bank. No, 2 other banks. That's what you've learned from this crisis, right? So I think that's what you got to do going forward.
Fair. I think my last closing question per se here is, This seems like a very US phenomenon. And I know some of our startups will have exposure there because if you had raised money abroad, you might have your money abroad and perhaps dangerously in SVB as well. What of all of this are lessons we can apply to India, either in a short term or on a micro level, like individual startup founders and so on, but also on a bigger scale, like companies here which have Indian funding and Indian bank accounts?
No, it's a very good question. In fact, what happens now is the Indian startups mostly don't have that exposure to SVB, but some of them do. The SaaS companies that serve the US market from a B2B perspective, many of them open Delaware C companies. Nobody else would open an account for a Delaware C company remotely, so they would get accounts at SVB. SVB would then, the funding would be received over there and so on. You've had a situation where this money is now blocked or lost. So you gotta either get a bridge loan or something like that from another startup, another bank, to be able to operate while this receivership is realizing some of your money, and assume like 20% of your money is lost. So, kind of deal with it and move on. Indian companies have actually faced this in the past where they've received money, and I think there's a public case of this. One public case is Oyo, where they put 100 crores of money in a fund called a JP Morgan something fund. And that JP Morgan something fund went and invested in a debt of a company called Amtech Auto, which promptly defaulted. And therefore, that fund had to be shut. They got back some of their money, I think 50-70% or something of their money, in a few months. While while that fund kind of, this is before all this major debt crisis happened in India, which is because because of which a lot of other rules came. In fact, JP Morgan sold its fund in India and left the country, so it no longer runs a mutual fund in India. The thing that happens is when things like this happen, do Oyo shut down? No, Oyo kind of realized that this is part of the money that's gone, and waited for the money to come back and kind of dealt with it. So I think panicking too much is not a useful thing. Note, however, that sometimes your VCs also kept their money in Silicon Valley Bank. So it's possible, and very remote right now, but we don't know the answer to that some of your VCs may actually go bust because of this. Your VCs may no longer be able to fund you. I have no idea what happens to the shares you gave them in this situation, but most probably that will get acquired or merged in some kind of a crisis. But I think that's one part of it is true within Indian startups. And I think this is a very interesting, because India's always had positive interest rates, right? Very high interest rates relatively. So if you've received funding, and many of our startups we talk to have, diversify the cash flow that you've received into multiple instruments. Some of them can be ultra short-term funds, some can be gilt funds, some can be bank deposits with different banks. Don't go down the cooperative bank route and all that. You don't want to go down the equity route also, because it's more risky. But in general, diversify across multiple things and try to match your liabilities with your assets. Sometimes you know how much you're spending each month. Try to get whatever you invest in match to that month. So if something is I need money in the next 3 months, I want to be in a liquid or an ultra short term fund. If something is maturing in 6 months, I probably want to be in either a low duration or ultra short term kind of fund. But anything I require in 2 or 3 years, I shouldn't actually go and invest in something that is like 50 years in duration, maybe some part of it, but I need to keep some money short, because it's possible that I get these sudden needs of liquidity, and then if that thing is down 20%, I will hurt myself by getting out at the wrong time. So one is, of course, you can spread your money across, but you should be aware that at some point, liquidity comes at a price. That means if India raises interest rates a lot, long duration funds will lose money. So when India starts raising interest rates a lot more, you don't have to do it right now. You should react and move the duration down at that point. Right now, our interest rates the long-term interest rates are still, honestly, in India, whether you invest for 6 months or for 20 years, you're getting the same interest rate in India. It's flat. But things could change. And when things change, you should change your portfolios alongside. We haven't been bad. What we shouldn't do is lock your money. I think that's the don't lock it with one bank, don't lock it with one institution for too long. I would in general say the thing that applies to India most is we have a banking system that seems to be very conservative. So our banks are relatively in far better shape. And we have far more instruments. The US does as well, but and startups use them. What we should be really afraid of is bank runs in India as well can cause as much or more damage. We should have a system that does not, somehow discourages people from shouting fire in a crowded theater. You should not have the VCs of India also telling people to take their money out of X bank or Y bank. There are banks that serve startups almost exclusively. And some of the banks have actually made a lot of money by and help banks become neo banks or self startups become neo banks and all that. So if tomorrow the same Indian VC started to talk about, so you know what, get out of these banks, they're too small, go only to the large banks, you could cause a crisis in India. Maybe not as much of a crisis because Indian banks are more diversified, but they shouldn't do that. I would also advise, and this is not just India but worldwide, the VCs that exist should somehow pay into some kind of a fund that is kept entirely for funding startups when they go into this kind of a crisis. Banks do it. No, they call it deposit insurance.
So
Why don't
VC
VCs,
insurance?
Yeah, call it a VC insurance. But it'll happen once in maybe 5 or 6 years. But at least you'll have a fund. Hey, you pay, I don't know, pennies, man. If you've raised $150 billion, pay like a small amount into a kind of an insurance fund that helps you tide over crises like this. You know that some of it is, and it's going to be parts of your management fee. Very tiny parts of your management fee that goes out. So I would say that's the closing point. But the story has probably just begun, unfortunately. We will have a lot of more podcasts like this, I imagine, in the future.
I just hope that they're all on a happier note and that we wake up on Monday to find someone has bought this whole thing or that all VCs have banded together, which it seems they might be doing to extend short-term credit to funds. So on that, Deepak, thanks so much. And let's honestly just hope for the best for our friends, startup founders and so on, and everyone who's been impacted by this. And
So I'm going to be as unbiased as possible and say that, listen, I hate the fact that this crisis actually happened. I hate to see a good bank go down. But the fact is it has happened. I'm going to be very practical about this and say you have to just look at what happens to you. And, I wish everyone all the best. I hope things work out and does not hurt the system too much.
Deepak, welcome back. I guess we have to record this epilogue. So they did step in, and I think the Fed did step in last night. And it's not quite a bailout, but at least depositors won't have to lose any money and won't be losing any sleep. So can you tell us what happened?
Good question, Shrey. We just recorded the podcast and then the next day, it was the night of the 12th in India, which is, evening of the 12th in the US is where the US Fed stepped in and said, we will make all depositors whole, which means the bank ceases. All the senior management is fired. Shareholders get zero. And they guarantee all deposits. Now, this was a problem because obviously they don't seem to have enough assets after those mark-to-market losses compared to what the liabilities are. So it turns out two things. Firstly, there's a $42 billion withdrawal that happened apparently on the 9th of March, which was the Thursday after this. Now, $42 billion is a lot, so obviously they had to go into receivership immediately. So instead of saying, okay, should we honor the 42 and should we not try to do something with the rest and all that stuff, they just said, listen, let's honor all deposits. How is this going to get honored? Without taxpayer funds being used. So FDIC has a insurance fund of $100 billion. They estimate probably the losses will be covered by this $100 billion for two banks, SVB and Signature. We'll come to that because Signature is another large bank that went bust in the same time frame. The idea here is that the FDIC will get money from the deposit fund and use it to bail out all deposit holders. So anybody who has money in the bank gets all their money in the bank Monday morning. They can transfer it to any other bank.
Which they will. They will.
They have to because the bank ceases to exist, right? So only the employees will remain for the next few days and then even the employees will have to be let go. So Silicon Valley Bank will cease to exist as an entity soon after all these transfers are done. There is no concept of a receivership anymore. Everybody's just been made whole. What will the Fed do now? So Fed has also opened another window. They've told all banks, listen guys, if anybody's trying to take money from you guys out, you're going to need money to pay them. So the Fed has opened a new window at the discount. It's like the discount window, but the discount window is usually overnight. This is a 1 year window. So you borrow, you get the money for a year. At I think there's a rate called the overnight swap rate. The overnight swap rate is traded in different durations. So it's a 1 year overnight swap rate or a 6 month overnight swap rate and so on. So the 1 year overnight swap rate plus 0.1% is what you have to pay for this. Obviously, this is a very high number today, but that's what the banks will be able to borrow at to meet any short-term liquidity needs. And therefore, what do they place as collateral with the Fed against this? They can place all these securities that they own. Now, given that these securities are the problem, in the sense their value has gone down, they'll say, the Fed says, I don't care about their market value. Whatever face value you bought it at, I'll take that as collateral. So, for instance, the other case, FDIC has created a new bank called the Silicon Valley Bridge Bank of sorts. So in the sense, it's a new bank that has acquired Silicon Valley Bank already. This bank will be able to use all the securities that are there with Silicon Valley Bank and borrow money against it. That money can then be used to pay off all the depositors, and over a period of time, the FDIC can hold till maturity. So technically, they don't have to, these intermediate losses won't apply to them. So they can wait till the maturity and then get all the money. It could take 10 years for FDIC to recover all the money, but that means that they don't there is a certain cost to this entire operation that will be borne by the insurance fund. This means that every depositor putting money into any bank, the banks will have to pay insurance fees which are higher than earlier. But effectively, this is paid by that part of the system. It's not going to the taxpayer or the US government to backstop this process. Assuming, of course, these are the only two banks, and Signature Bank is also a $110 billion bank, so it's not a small bank. It has about $80 billion in deposits. This has about 160. So totally $240 billion of deposits have been guaranteed now by this FDIC fund. And they're assuming that because you've invested well, you've not lost money on the investments, you're likely to recover most, if not all, of the money. And it may take some time, so we'll need some time to kind of gather all the funds. It's a bailout in the sense of the depositors get made whole, but the companies are gone. So in a way, it's like saying that PMC Bank in India was not PMC, but Lakshmi Vilas Bank in India was a bailout because there the depositors were made whole. It was bought over by DBS, but DBS made good all the depositors, but the shares went to zero. It was a listed company, the share went to zero. So it's happened, but it is probably too early to say what next.
I hope not, because I can't record a second epilogue.
Yes.
But just coming back to this, look, this does feel at least emotionally like a more satisfying conclusion that it's generally unfair to expect the depositors to have known better. And we've discussed this. So at least now they will be made whole. This certainly now, I don't think anyone is panicking about banks going under the way they would have otherwise. So there's no contagion, if I may call it that, or panic. But there is some sort of a bailout. Basically, someone is fronting X today saying, look, I'll take your illiquid or longer dated thing. And I know I'll sort of get most of X back over the next 10 years. So someone has paid up, and it sounds like it was mostly the insurance, FDIC, and to some extent the Fed on some things. So has this created a new sort of, I don't know, can I call it moral hazard, or is this the surgically precise intervention to have done?
Yeah, it's a good point because moral hazard might continue to exist. However, I don't know what anybody else would have done better. Of course, we've already said that they need to have changed their portfolio over time. But there is a disincentive in the sense if you screw up, the company is gone, the bank is gone, your management is gone. So the management does not really have an incentive to do this versus...
Bondholders also wiped out, right?
Not all unsecured bondholders are wiped out, but secured ones are still part of the process. So secured bondholders plus depositors get all their money back. Unsecured, nobody gets their money back. Employees continue to get their salaries for whatever time they are employed with the bank. And in fact, some of the employees will be paid 50% or 100% higher than what they were because this is a very short period employment.
Yeah, I mean, I assume they need an incentive to come in for the next 1 or 2 weeks and make sure everyone gets their money back, and then they can wind this down.
Yeah. And the thing that happens now is to see what happens to the rest of the banking system, which is not very big. So, for instance, there are a bunch of other banks who serve startups
Whose signature? What? So one more happened over the weekend, basically. So Silvergate, these guys, and now Signature.
And Signature is a $110 billion bank. If it's the third largest bank in US history to fail. So the second largest bank in US history to fail was Silicon Valley. Third largest is the Signature, and both of them failed over a weekend.
Yeah.
So there is some sort of fear in the marketplace. However, I feel given the situation that it is right now, the Fed will calm things down, and there might be more bank failures. There were 80 bank failures in 2009, probably 15 in 2011, and a bunch of things. So we've had only 3 or 4 so far. So we should expect that more banks will fail. But the playbook seems to be protect the depositors of systemically large banks, which Signature and Silicon Valley are. I don't disagree with this approach. I think it creates a small element of moral hazard, but the moral hazard does not actually translate into bad behavior incentives, because I think if you fire management and make their shares zero, most Silicon Valley top management was paid by shares, you're effectively disincentivizing them from doing something stupid that FDIC takes over. So we'll protect your depositors, but you're gone is a fairly good disincentive. They didn't do this in 2008. All the banks that were bailed out continue to have the top management run the show. So I think that way it's good.
So hopefully it's a better bailout.
It's a better bailout than otherwise, and I'm happy that depositors are not taking the hit, because that creates a little more fear.
That is quite a relief, I would agree.
Just one thing to add here is that if you're a startup in India that has raised a lot of money, or an individual who has a fairly large amount of money that's concentrated in a few banks, consider using different instruments to diversify. You can use money market mutual funds. You can use short-term mutual funds. You can use bank deposits. RBI has opened up T-bills for all of us to invest in. Connect with us at Capital Mind. We can try and help you navigate through a crisis if you think that you need to diversify and are finding yourself short of ideas. Thanks so much.
So, well, thanks, Deepak, and thanks everyone for listening. If you've liked what we've had to say, then do see more of our episodes at capitalmind.in/podcast. And if you have any feedback or ideas about new episodes or topics, then just send them over to podcast@capitalmind.in. Thanks.